Welcome back. You're watching us here on Chartbusters on CNBC-TV18. Now, as promised, we have the management to, speak about the primary markets. Indegene, a company that provides digital solutions for businesses engaged in life sciences, opens up for subscription today. The company is raising close to around, the issue size is 1,800 crores. The company is raising about 760 crores as fresh. And then there is the PE exit that happens as well. We do have with us, the CEO and the CFO of the company joining us. Thanks a lot, gentlemen, for joining us today. Good start to the IPO because you have a good list of anchor investors, etc. as well. Just wanted to know a couple of things. Of the fresh issue that you're raising, 760 crores, how much of that would be, going into debt repayment? What would be the debt that remains on your books?
So, out of the proceeds of 760 crores, 391 crores approximately is towards the repayment of the debt that we have on our books. And with that, we would be a zero debt company post-repayment.
Okay, and welcome to the studio, gentlemen. Wishing you all the best with regard to this IPO. What would the rough savings be? What was the borrowing rate on this debt? So if you could calculate the broad interest savings.
Yes, so the interest savings, given that this loan is on the books of the foreign subsidiary in the US, it's a dollar-designated loan, and the interest savings would be in the region of about $4 million US per annum.
Right. A lot of people are wondering what exactly is it that you guys do. And what we've understood from your issue so far, it looks like you are a support function to the life sciences business. So maybe somewhere like what a BPO does for other businesses, you guys do for life sciences businesses. Would that be the correct assessment?
Not really. We are a unique company. 25 years back, when a few of us started the company, it was founded on the thesis of bringing deep medical expertise, healthcare expertise, along with technology expertise to solve problems in the healthcare industry. If you see our team today, we have close to 5,200 people. 20% of them come from a medical background. These are medical doctors, PhDs, pharmacologists, who are working on one hand with people like data scientists, data engineers, software developers, analytics professionals. On the other hand, people with brand strategists, omni-channel orchestrators, digital specialists, modular content leads, art directors, creative directors. We call, in the marketplace, we are known as a digital-first commercialization partner to the global life science industry. We work with all the top 20 global pharma companies as our clients. All of them are our clients. Total 65 customers, presence in 17 offices across the world. And what does digital-first commercialization partner mean, right? I'm going to explain that. Now, life sciences industry is a very complex industry, right? On one hand, you're working in the lab, right? There are scientists who are coming up with a new product. That by itself is a very difficult area to deal with, right? Coming up with the product. Now, once you have a product in the lab, bringing it to the market is again a highly difficult process, right? You have regulators.
So that's where you guys come in.
Yeah, absolutely. To regulators, helping with the filing of submissions, reaching out to physicians, patients, right? Dealing with all these processes.
Okay, all right. Let's get to a couple of numbers, then I can, feel the passion in your voice, the way you're talking about the business and the way it's evolved over the last few years. But the market's about numbers. Absolutely. So, if we could get a brief idea of how things are panning out. Now, margins have got diluted a little bit in the last few years. Why, first of all? And could you tell us what could be the broad band, if you could give us some kind of indications? Also, growth. You'll have grown at a fair clip in the past. What kind of momentum will you all maintain going ahead?
I'll pass it on to Suhas to get into details. But I want to point out we have, as a company, very strong growth for many years. Margins also at EBITDA level have been stable. At a PAT level, because of some one-off things and debt, have been a little bit of volatile, but let's ask.
The margin number as of FY21, the number I have is around 23%, and that comes down to around 17%. So I just wanted to get some clarity. So please go ahead.
Yes, so I would like you to bring your attention to the EBITDA margins. Yeah. And the EBITDA margins from FY22 to the 9-month period ending December 23 have been steadily rising from 18.8% to a 21.9% through the period.
Okay.
The period prior to that, FY21, was a higher 27%, but it has its own intricacies. As you would recollect, it was the year of COVID.
Right.
And therefore, keeping those intricacies aside, if we look at it, it's been a stable growth on the margins. And our aspiration is to sustain and grow that going forward as well.
Right, sustain and grow the margins going forward. Let's talk about acquisitions, because that's been an important part in your growth journey as well. 13 acquisitions since inception, the most recent one, Trilogy Writing and Consulting. Just wanted to know, how much do you typically look at spending on acquisitions every year? Do you have a growth target that comes in from inorganic versus organic? And how many of these assets have been completely sweated out, and what's the outlook going ahead?
So when we think about acquisitions, we never think about it from a budget or, I'm going to get so much growth from this. The way we think about acquisitions is that we think about our customer solutions and think about what capabilities does this acquisition bring to the table. Using that, can we add more value to our customers? And most of our growth has been organic in nature. What these acquisitions have added are very specialized capabilities.
Okay, all right. Final question before we let you go. Geographic breakup. How do you all see it pan out? As of now, I think North America accounts for bulk of it. Europe as well is the fair bit. So how do you see the geographic breakup pan out? And also, as of now, you're in pharma, medical devices related. At some point of time, do you see you move out of this, or this is the area that you want to focus on?
So from a geographical split perspective, our revenues pretty much mirror the pharma industry spend. Pharma spends 65% of their operational spends on US. We have 66% of our revenues coming from that part of the world. 25% is spent by pharma in Europe. We get 30% of our business coming from Europe. 4% is for us is the rest of the world. Now, as far as split between different sectors are concerned, we work with biopharmaceutical companies, we work with medical device companies, we work with emerging biotech. It's a very large industry, 1.8 trillion, slated to be 2.1 trillion. And we believe we have significant headroom to grow and strong strengths to capitalize on. So we'll stay focused on this industry.
It's been a pleasure speaking to you all. Thanks a lot, gentlemen, for coming down to our studio.
Thank
we
you
wish
so
you
much.
all the best with regard to the issue. And on listing, we invite you to come back on the show.
And give us a lot more numbers.
Push you a little bit for numbers. But for the time being,
Absolutely. Thank you.
Wish you all the best.
Thank you.